Welcome to Market Monday from the investment team and the trust department at the First National Bank. There are quite a few important data points over the next couple of weeks, so we're going to start there and then move into equity markets and some of the indicators we've been watching and are expecting, and then round things out with a discussion of the interest rate markets and what they're telling us about the potential future here, and certainly what they're telling us about current income conditions for income investors. Starting things off, information about capital flows today, information about the real estate market tomorrow, more information about the real estate market Wednesday morning, which will be followed by the main event, which is the FOMC rate decision. And as the Open Market Committee meets, you can notice here the survey shows unchanged expectations versus what the prior reading was in that overnight rate. And that is reflective of expectations that the Fed is not going to do anything at this meeting. They're going to pause again in the rate hiking cycle. And we think there's a non-trivial chance that there will be a quote-unquote surprise hike. And that's on the basis of the fact that we've been getting quite a few recent inflationary reports and quite a few reports suggestive of lingering strength in the economy. And as such, that might prompt the Fed to action, particularly since at the Jackson Hole meeting, the chairman came out and basically used some extremely hawkish language, meaning, we're going to do whatever it takes to get inflation under control. That's, whatever happens to markets is secondary. So with that viewpoint and the facts that have been coming in, we think there is a chance that they may do something that's a surprise and hike rates at this meeting. But at a minimum, they're going to likely have a very harsh tone in their press conference and in the statement that comes after the action or lack thereof, and that would indicate that they are still going to be very focused and hypervigilant about inflation. That could lead to increased volatility as we go forward into the week and into the next week. We get information about the labor market Thursday, and at the end of the week, we're moving in. Information about outlook and sentiment. Next week we have information about real estate. Consumer confidence will be a key number. This is expected to show a growth from the prior period, and we think that this number might again, quote unquote, surprise, because first of all, consumer confidence drives about 2/3 of GDP growth. So consumer confidence is driving consumer spending, and we want to see what's happening with consumer spending to forecast what's happening with the economy. So when we see the consumer confidence number coming up, it will be really interesting to see if that number actually does grow or if it sees a decline, because there's a big significant thing out there in the marketplace. The restart of student loan payments is starting as of October 1st. And that is expected to take significant amounts of money out of the discretionary bucket in consumers' pockets and send that instead toward the servicing of outstanding student loans, which has not been the case for a large number of consumers for the past few years. So it'll be interesting to see if this number is declining and comes in lower than expected by a good margin. That would be an indication that now we need to really watch for a weakening economy, because the consumer has grown a lot weaker and is starting to tighten the wallet and potentially going to tighten it even further. We'll get manufacturing. We'll get durable goods. That's another big one. That's expected to show a decline of 0.5%, and it's important because people are only buying the durable goods, at big ticket items, when they expect that the conditions are going to be better. And so when you start seeing negative numbers in those orders, that's reflective of a poor outlook for the future. Or I shouldn't say poor, but poorer outlook. And the other big main event that we were talking about when we started, the first being the Fed rate decision. Here we get GDP, and it's expected to show growth at 2.3% versus the prior reading of 2.1. That increase suggests that the economy is still going strong, still in a growth mode, and potentially can weather another rate hike, but certainly is not the type of a GDP number that would be indicative of a need for the Fed to slow down. So, we'll see what happens there. Information about incomes, that speaks to spending, and then spending more directly, which is expected to show a slowdown. 0.4% is what the expected number is versus the last reading of 0.8% growth in spending. Moving in, finally, at the end, we get sentiment information. More sentiment information. Factory orders is a big one, more durable goods. And we'll get more labor market information to round things out. Consumer credit, which has been growing and growing, and it'll be interesting to see if that's still growing, especially amid reports that credit conditions are tightening. So that was a lot. what's the actual market doing? And this is the S&P 500, which has been meandering through the end of last year and into now in an upward trend. And it looks like that upward trend is starting to slow down. The market's tightening right around this 4,500 area, and we're getting all this important data. Now, in terms of volatility, this is the volatility VIX index, which measures that based on option pricing. And as you can see, volatility has been coming down ever since the markets bottomed late last year, and now is at levels that are very low. And in fact, if we look at this on a really long-term basis, this reading of 13.95 is actually very low relative to normal historical standards as well. However, notice all these big spikes in volatility tend to come from levels where they're near where we're at now. So it'll be interesting to see if that'll hold, because remember, from a seasonality perspective, September and October, along with March, are the periods where you most expect volatility. And earlier we referenced reports that talked about, that we're coming in a little hot. So looking at the GDP, that number is growing. That shows actually an increase from the end of last year until the last reading that we got. And it's going to be interesting to see if the economy is continuing to grow and it's actually increasing its growth. That's a bullish indicator for the markets in general, but it's certainly not disinflationary, and it leads the Federal Reserve to conclude that it has to continue. Core PCE, which is what the Fed uses to determine what its inflation that it's targeting is doing, is at 4.2% as of the last reading. And while that's down from recent highs, it's still high by relative standards, and it's certainly much higher than the 2% that they are explicitly saying that they're targeting. So it'll be interesting to see what happens. Moving finally into interest rates, the Treasury yield curve is inverted now by an historic length of time. I want to say it's something like 200 days, and it's longer than any other period in history from information that we've read. So when we look at this inversion, the 2-year paper having a higher yield than the 10-year paper, what that suggests is, the short-term rates are obviously higher because the Federal Reserve has been hiking interest rates in an attempt to control inflation. The longer-term rates, which are actually pegged to inflation expectations, remain a little bit lower, suggesting that the Fed's moderately successful, but we have to think of 10-year paper as a break-even rate. In other words, if you're an institutional investor and you want to be in the risk-free asset, there's only one concern that you need to be compensated for, and that's inflation. So in a rational world, investors will buy this paper up to the point where yield is at the exact point where they expect inflation to be, and then they won't buy any more because there's no economic reason to. The yields will drop below the inflation expectations, so therefore they're not going to buy them. And so when we see 10-year paper at 4.31%, that's a pretty good proxy for what large investors see as longer-term inflation expectations on average over that period. Much higher than the Fed's stated 2%. Again, they're probably going to have to get more aggressive if they want these yields to come back down. They're probably going to have to be riskier with respect to courting a recession in order to get those yields to drop to a level that's more reflective. In terms of corporate bonds, this is a great environment relative to recent history for individual investors and income investors in general. The yield across the board is above 5%. In some cases, we're approaching 6%. And that's really good in the grander scheme of things, because people are buying bonds for current income, but also to reduce portfolio risk that's inherent in equity exposure. And when they're looking at getting paid 5.5% or something thereabouts in terms of holding a pretty safe asset, in fact, a very safe asset, high-grade corporate paper, that is a good situation for investors in general, whether you're in a blended portfolio of equities and bonds or you are just a flat-out income investor. So moving back to the markets, we're going to end this the same way we always do, by zooming out. It's really interesting to say, hey, we've seen this consolidation going on in the market, and maybe we're a little bit worried the market's looking toppy, or we're expecting some more volatility, but we're not going to worry about that. We're not making changes to the long-term investment plan based on what's going on in the short term. We saw a bear market. We saw 2020. We saw the 2008 financial crisis, and yet the market, as the S&P 500 came up from around 1,000 all the way up to about 4,500. That's not including the lows down here, which was in the 600 handle. and it's moved up multiples of that. So we're concerned about the longer term trend in markets, and we want to remain invested to achieve our long-term financial goals. If you have questions about the market, if you have questions or concerns about volatility, what's going on in the economy, feel free to reach out and call us. We're here. Thanks. Hope you've found this video useful. Have a great day.